Hello, everyone. I'm Brian Burke, Chief Commercial Officer at Seco Logistics. We're a global mid-sized freight forwarder and 3PL with locations in over 50 countries around the world. We provide air, ocean, and ground transportation services in addition to e-commerce, fulfillment, white glove, customs brokerage, and compliance solutions. I'm coming to you from our headquarters in Chicago, and I've appeared in publications such as the Wall Street Journal, New York Times, Washington Post, USA Today, as well as appearing on CNBC, Bloomberg, and Yahoo Finance, discussing issues around global containerized trade and tariffs, just like we are today. I'm excited to be with all of you today to discuss some very important and timely topics. And thank you for joining our program. But before we begin, I'd like to cover a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program. If you have any questions during the webcast, please submit via the question box. We will try to answer all questions during the webcast today, but if a fuller answer is needed or we run out of time, it'll be answered later via email. And you can ask questions throughout the entire time, but we're going to reserve the answers once we get to the end. We got a lot of material to get through, a lot of information, at least as of 10:30 Central right now. The slides are as of now. A PDF of the slides are available in the program materials folder along with presenter bios. Toward the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. Well, that's all for the housekeeping items. Let's get started with our program. Presenting with me today is Bob Stang with Husch Blackwell and William Jansen with Seco Logistics. Bob is a partner at Husch Blackwell based in Washington, D.C. He focuses his practice on customs and international trade law. He brings 40 years of experience to a wide range of issues that affect inbound and outbound goods, including tariff classification, valuation, country of origin marking matters, free trade agreements, and specialty trade agreements. He also has extensive customs compliance experience and regularly assists importers facing U.S. Customs and Border Protection audits, penalties, seizures, redelivery notices, and other agency enforcement activities. Bob works with importers and exporters proactively to achieve cost savings and structure programs that meet CBP's reasonable care requirements. Seco works with Husch Blackwell Transportation Practice. We appreciate their continued support during this very dynamic time in global trade. William Jansen is a licensed customs broker and certified customs specialist and is currently director of customs brokerage at Seco Logistics. William also serves as the chair for the National Customs Broker and Freight Forwarders Association Anti-Dumping and Trade Remedy Subcommittee, in addition to serving on the Trade Support Network. Bob, William, tell us all about the latest on the tariffs in the United States and the considerations for importers. Over to you.
Thank you, Brian. We really appreciate the opportunity, and we thank everybody who's taking the time from their busy day to join us on this webinar. We're going to start with looking at the trade landscape, and that is President Trump's America First trade policy. And he's supposed to be receiving reports April 1st or April 2nd from a number of different agencies. But the America First trade policy, you can see, it has a number of different drivers to it: U.S. manufacturing, unfair trade practices by a number of different countries, or what are alleged to be unfair trade practices, and then a variety of issues: free trade agreements, labor, environment, a pretty wide variety of issues. The key actors right now, the full list of folks isn't entirely built out, but Jamison Greer, the U.S. Trade Representative, who was the chief of staff to Ambassador Lighthizer, the USTR under the first Trump administration; Peter Navarro, who's known for a very conservative and very hawkish view on trade; and then Howard Lutnick, the Secretary of Commerce, who in Commerce they have yet to put some of the undersecretaries and key folks in place. So with that, let's look at what's actually being used out there to drive this trade agenda. Billy, do you want to talk briefly about what we're calling Trump 2.0?
Yes, thank you, Bob, and good morning to everyone who's able to join us. This slide goes over past, present, and short-term future of where we think this administration could go as far as trade policy, with the first line covering where we left off in Trump 1.0, where we had tariff provisions on goods from China, specific tariff provisions on washing machines and solar products, and then steel, aluminum tariffs as well. Going through the different threats and promises on this list, it goes through the reciprocal tariffs that are due to be presented on April 2nd. And then just a note on the future of where those could go from there in terms of just dialogue on tariffs on timber, lumber, copper, food, and pharma. We're going to go into each of these in depth, and I'll hand it back to Bob to start that.
Thank you, Billy. So the first provision we're going to talk about is the International Emergency Economic Powers Act, IEEPA. And what we're emphasizing here is that each of these different provisions, these statutory provisions we're going to talk about, IEEPA, Section 301, Section 232, 201, they all have their individual procedures. And so when folks are trying to identify what tariffs apply to them or what might happen for a particular tariff provision, you really have to look at the individual statute. For IEEPA, it requires an unusual and extraordinary threat to the United States from outside the country, as opposed to a number of other statutory provisions. IEEPA, which the Trump administration seems to be using extensively or intends to use extensively, it has very little institutional constraints. Certainly no time constraints, subject matter constraints, and very few limitations on the president in general, which of course is a reason why it's probably being used. It has very little history, although in the first Trump administration, the president did threaten Mexico with tariffs under this provision in 2019. So as it's currently being applied, IEEPA has been raised with respect to Canada, Mexico, and China with respect to illegal drugs, specifically fentanyl. And this is where folks have heard about tariffs being imposed because of fentanyl coming across the northern border or coming across from Mexico. In our opinion, there's really been actually very little, very little fentanyl coming across the northern border. Nevertheless, at one point, the president was threatening an additional 25% duty on products of Canada, an additional 25% on Mexico, and an additional 10% on China. We'll get to that in a little bit because, as folks know, the 10% on China was actually increased. Going back to if you're going to identify what is the impact of these tariffs on your product for IEEPA, it's got to be a product of Mexico, product of Canada, product of China. What does product of mean? Okay, in the Federal Register notice on these or in the customs messages, and we've put the references to those up there. For Mexico and Canada, it means either substantial transformation or it means that you qualify under 19 CFR 102, 102.20 or 102.21 if it's apparel, which has a more product-specific rule for these. For China, it's actually that they have not actually been very clear or certain as to what is a product of. However, we believe that for China, if you want to determine whether your goods are a, quote, product of China for IEEPA purposes, then you should be looking at the substantial transformation rules in Part 134 or the numerous customs rulings that are published on the customs website. So, Billy, do you want to talk about IEEPA with respect to drawback and de minimis and FTZs?
Yeah, absolutely. So these IEEPA tariffs are designed to cut out some of the more traditional tariff mitigation or tariff avoidance options. First is duty drawback, where importers can claim those duties back when goods are exported or destroyed. That provision is not allowed under IEEPA. So IEEPA tariffs are final, and they do not get refunded if the product is exported or destroyed. I'll skip de minimis for a second and go into foreign trade zone, which is a mitigation option where companies can manufacture in the US, and if there's a tariff inversion, they can take advantage of that. Here, the tariff rate and rate of duty is locked at when it's imported. So you cannot enter at a lower tariff if it's manufactured in a foreign trade zone. De minimis is a fulfillment, is often used for international fulfillment, where retailers can use a Type 86 entry type to enter goods under $800 free of duty. The IEEPA orders remove de minimis from products of the three countries, Canada, Mexico, and China, the most impactful of which is China. The implementation of this piece of the order is currently delayed until the Secretary of Commerce determines systems are in place to properly assess the duty and collect the data required for these types of imports. A collaboration effort between USPS, FedEx, and UPS, DHL, and all the other Type 86 importers is underway.
Great. So let's look at what's happened with IEEPA since February 1st, when they announced the 25% tariff on Mexico and Canada and the 10% on China. Well, and this really emphasizes that you really have to keep up with what's going on, whether it's IEEPA or all the other tariffs, on a day-to-day and sometimes even on an hourly basis. February 4th, the IEEPA tariffs on Canada and Mexico were delayed. February 7th, they reinstated the de minimis exemption that Billy just mentioned. Fast forward to March 4th, the 25% IEEPA tariffs on Mexico and Canada went into effect, and the IEEPA tariff on China went from 10% to 20%. March 5th, the IEEPA tariffs on Canada autos, it was suspended, and then March 6th, basically, the IEEPA tariffs on Mexico and Canada have been delayed until April 2nd. But when we say the IEEPA tariffs on Mexico and Canada, it's only for goods that are USMCA qualifying. So if you are importing goods from Mexico and Canada and they do not qualify for USMCA, then we believe that they would be subject to the IEEPA tariffs. And this gets back to April 2nd. We anticipate that the key drivers in commerce, Treasury, USTR, will have their reports to President Trump. So when will the IEEPA tariffs be removed? Billy, any thoughts?
Well, so the reason for the IEEPA tariffs varies slightly differently from country to country, where you've got Canada looking at the flow of fentanyl, as well as China, and then Mexico addressing immigration as well. But as you can see in the language of the executive orders, there is a common denominator between these three orders, where the president determines when sufficient action has been taken and those tariffs will be removed.
So let's go to Section 301 now. And folks will remember Section 301, these were imposed under the first Trump administration, and the Biden administration maintained them. And as opposed to the IEEPA tariffs that require an unusual and extraordinary emergency, Section 301 tariffs really go to acts, policies, or practices, not necessarily an emergency, but that violate an international agreement that the United States believes are unjustified or discriminatory. So it's actually the act. And they focus on the country, most importantly right now, China, not necessarily the goods. And once again, each of these different tariff provisions has its own procedure. And so we've just basically identified what some of the procedure under Section 301 is for the president to impose tariffs under there. So under Section 301, where are we right now? Well, once again, this is the Trump tariff provision that was used during the first administration. And there's 25% tariffs on China. List 1, List 2, List 3. If you're under List 4, List 4A, it's 7.5%. As folks know, there's ongoing litigation right now, although the Court of International Trade upheld the administration at the lower level, and it's on appeal at the CAFC. There was a statutory 4-year review that the report was issued in May, and when the president has looked to re-up the Section 301 tariffs, it's interesting that they referred back to the comments that they received in the 4-year review, which we think was part of what they were doing to meet 301 procedures. They've also granted exclusions under 301, most recently for solar manufacturing equipment. But the more interesting thing we think is, where might we be headed under Section 301? And we think that based on what happened in the first Trump administration, that we might very well be headed to countries other than China. Folks will remember the 301 dispute against the European Union and the UK under large civil aircraft, which involved a heck of a lot more than large civil aircraft. They actually were looking to impose tariffs on cheese and alcohol beverages and a wide variety of matters under there. There was a 301 provision, a 301 petition on fentanyl, but that was withdrawn, understandably, since they're now looking to cover that under IEEPA. Nicaragua for labor rights and human rights. So it shows that what's complained about, the unfair act, it's going to be very broad, and we would not be surprised at all to see 301 cases on labor, on environmental issues, those sorts of things. And then, of course, also there's we anticipate a very broad 301s in terms of the sectors, and we would point out the current 301 petition initiated on the maritime logistics and shipbuilding sectors. Once again, there is a very specific policy, as opposed to IEEPA. There are more specific policies and procedures and requirements under Section 301, and particularly if you're going to modify or terminate an action taken. So what that tells you is that if the president is going to modify actions on China under 301, he has more restrictions on him. So moving on from Section 301, let's talk a little bit about Section 232. That's really been in the news. These are the steel and the aluminum tariffs. We would emphasize that these are imposed for national security reasons. Once again, there is a procedure. These were used during the first Trump administration when they imposed a 25% tariff on steel and a 10% on aluminum. And they did give exemptions the first time that they used the 232 tariffs. But let's look at 232 today. And we've put up the citation to the Federal Register notice. If folks want to download it. They went into effect on steel and aluminum March 12th, so just a couple of days ago. 25%, okay? No exemptions. So all of those exemptions that were previously granted, they are gone, with the exception that for aluminum, if the aluminum is smelted and cast in the U.S., and for steel, which we'll talk about briefly, if it's melted and poured in the U.S. Billy, do you want to talk a little bit about Annex 1 that covers the derivative aluminum articles, or if it's in the steel, the derivative steel articles?
Correct. So the two headlines of these steel aluminum tariffs that were implemented early this week was the exclusion of exclusions, where countries or items that were previously excluded are no longer, and then the addition of derivative items into the scope of these Section 232 tariffs. So the way this is currently operating is Annex 1 of each notice contains tariff numbers in scope of these Section 232 duties. So tariff classification is key as a starting point to understanding if it's in scope. So if your tariff number, if your goods are classified within Chapter 73 for steel, 76 for aluminum, those 25% applies flat. If you have a derivative product that's within scope that is classified outside of those two chapters, duty is only due on the steel or aluminum content. So we'll get to that in a little bit. The complexity of these tariffs cannot be understated. The piece that is not being reported is that many of these tariff numbers that are derivative in the derivative lists may not contain steel, aluminum at all. And regardless, if any product containing steel or aluminum must also report the country of smelt and cast for aluminum and melt and pour for steel. Many importers are having trouble getting this data. They previously did not have to report it for derivative products. And it's been quite a strain on the trade this past week. Bob, if you want to talk about some of the news that dropped just hours before the implementation of these tariffs.
Sure. One of the requirements in the presidential proclamation was that the Secretary of Commerce had to issue public notice that there were adequate systems in place to, quote, fully, efficiently, and expediently process and collect tariff revenues. So this would include tariff revenues not only on the finished article, but if you had a product that was in a derivative other than Chapter 76 for aluminum, other than Chapter 73 for steel, to collect the tariffs on the aluminum or steel components in those products. Billy, in your experience as a broker, have you seen have you seen what those systems might be? Have you seen any systems in place to help brokers or to help importers identify what's out there to, quote, fully, efficiently, and expediently identify what the tariff would be?
Well, it's very clear that the tariff instructions were updated to say how these tariffs should be quickly and efficiently collected, but the system has not caught up. ACE in customs broker software has not caught up to operational reality. We are seeing entry errors and entry rejections on quite a few items based on whether the correct order of tariff numbers are applied. You'll see how challenging that could be in a few slides, and other things where we are trying to pinpoint the issue. But we're learning more and more each hour and trying to figure out if gaps are occurring within our API filing software or on customs side. And I've heard that this is across the board from others as well.
So this next slide is just the 232s on steel, but it's basically repeating the information that we provided on aluminum, that the 25% 232s on steel became effective March 12th. You have the same issue with, there's an Annex 1, the same issue in terms of the derivative articles in Annex 1, and the same issue with respect to the proclamation. Okay, the Secretary Lutnick, he issued his public notification, but issuing the public notification is different than actually identifying what those systems, what those, quote, adequate systems might be. And I think that might be an issue that's under development, those adequate systems. So moving on from the 232 tariffs, also there are Section 201 safeguard tariffs out there. The safeguard tariffs, they do not require that somebody has done anything wrong necessarily. No violations, no necessarily bad actors. They're really designed to give people breathing room for in instances where the International Trade Commission has determined that there are increased quantities that are a substantial cause of injury or even the threat of injury. And we would emphasize that on the safeguard tariffs, the focus is on the goods, and most recently, they've been imposed on solar cells and modules and large residential washing machines. So even though theoretically there are other statutory provisions out there, we think that those are the four big ones that are currently being used: the IEEPA 301s, 232s, and 201s. But once again, that's not to say that other statutory provisions could not come up. And so let's talk about what else might be out there. The president has talked about what he is terming reciprocal trade and tariffs. What are reciprocal trade or non-reciprocal trade and tariffs? Well, it's really not entirely clear. It appears to be situations where other countries put restrictions on U.S. goods that raise either barriers or actual tariffs in an amount more than what the U.S. has in place. Policies and practices that they're looking at include everything from value-added tax, actual tariffs, to exchange rate issues, and possibly what they're calling, quote, wage suppression and other mercantilist policies. We're not entirely sure what that means, but we would go back to the America First trade policy, and we expect that this will just become, if not talking points, actual issues that'll be covered under the reports that the president will get on April 2nd. In terms of additional products that companies should be looking at, copper and timber for either IEEPA or Section 232. We think that they're front and foremost. Timber from Canada, copper we'll see from a wide variety of countries. Billy, do you want to talk about the Restoring Trade Fairness Act?
So there is a multitude of acts that are introduced through Congress that target international trade to move more aligned with the president's policy. This one, the critical piece in this act is, again, removing all de minimis from China, which would have a major impact on e-commerce brands. And then this slide also discusses the multitude of other issues that are affecting international trade on a day-to-day basis: quotas, tariff rate quotas, forced labor detentions under the Uyghur Forced Labor Prevention Act, free trade agreements, anti-dumping, countervailing, IEEPA, and a plethora of free trade agreement renegotiations, USMCA, and then it goes.
And with respect to the USMCA in particular, just to update to either yesterday or the day before, when Ontario indicated that they were going to increase a surcharge on electricity to the United States, and the president then upped the Canadian 232 tariffs to 50%, the reset was that they would agree to start renegotiating the USMCA more quickly than what was anticipated, which was a renegotiation in 2026. But this really makes a great point that in addition to the tariff provisions we've just talked about, you've got all these other things setting the trade landscape. So with that, we're going to look at two particular products. Billy, do you want to talk about how the tariffs would apply to a woman's poly woven blouse?
Absolutely, and I think I can see that any retailer currently using de minimis to fulfill orders into the U.S. duty-free might be flinching right now at this tariff buffet that's happening. So a woman's woven dress, because classifying an apparel and apparel duty rates were so low the last 30 years, was tariffed at 26.9%. That's the most favorable nation rate, and that implies the duty rate in any country, that doesn't have a free trade agreement. In addition, Section 301 in 2019 imposed a 7.5% duty rate that is connected to the tariff number 9903/8815. And then starting in just 10 days ago, the IEEPA tariff at 20% applies. So I think the first thing you're going to notice is if you look at your entry summaries, your 7501 forms, they get longer. Instead of one tariff per line, you've got three, which highly complicates paying duty, calculating duty, and filing the entry on the brokerage side, which I know you all feel bad for us. The other impact here is duty drawback. Previously, duty drawback would be you exported one of these blouses and you got the duty you paid back. Under this, you only get 2 of the 3 tariff numbers back. So you might pay 54.4%. You export this item for an order fulfilled in the EU, Canada, Mexico. You're only receiving 34.4% of that duty back, 34.4 duty rate back. So roughly, you do not get the IEEPA tariff back. And we have a slightly more complicated example talking about the steel and aluminum tariff implications. So I found this item on a recent cross ruling I thought was very interesting. This is a gaming desk with integrated power charging. The surface, the desk piece, is steel, but you also have remote control LED lighting. You have 3 power outlets, you have wireless charging, and then desktop mounted cable management brackets, digital control panel, extendable mouse tray, headset hook, and cup holder. If nothing else, we know that the main piece of this desk is steel. So what is the duty rate? What is the classification? Normally, a steel desk, as with most furniture that's not subject to anti-dumping, is free unconditionally under the tariff classification 9403/20/0050. Going back to 2018, a 25% tariff was imposed for items with this classification from country of origin China. Going back 10 days ago, a 20% tariff was imposed under IEEPA. And going back 2 days ago, a 25% tariff was applied to the value of the steel content under Section 232 steel and aluminum derivatives. So I took the broker's test, and I know that most entries are valued under the price actually paid or payable, but my price actually paid or payable is for a desk. How do I know how to value the steel content? Bob, have you guys come across this yet?
We have, and you raise a really great point, Billy, which is now tariffs are going to be applied not on the value of the finished product, but on the value of a component of the finished product. And they really have not issued any guidance or any specific guidance on how to do that. So we're suggesting that companies faced with this issue really focus on 3 criteria. The first is when you're trying to identify the value of the steel component, or if it's aluminum, the value of the aluminum component, try and use a methodology that is as close as possible to the methodology used for the finished product. Billy, you mentioned the price actually paid or payable for the merchandise when sold for exportation. That's the definition of transaction value. And if you can use a methodology that fits into the definition of transaction value or some other basis of appraisement under the current U.S. statute, we think that that's a good place to start. We would also emphasize to folks that just like you have a reasonable care obligation when you're providing the value of the finished product, that reasonable care obligation extends to values provided for Section 232 tariffs as well. And if you undervalue goods for 232 tariffs, you have potential penalty liability, just like if you undervalued the finished goods. So when you're identifying a value, even if you can't be exact, really think about what would be reasonable. You don't want to just put down $1 or something like that. You want to have something that you can defend. And that's our third point, which is when you're identifying a value, think about what would happen if you came under audit by customs, or if customs reviewed it, or if you got a request for information. What sort of documentation, what sort of information could you provide to them? So that would be our guidance to folks who are facing that issue. Which kind of brings up the next slide here, which is importers want certainty, and they want to know if there's an easier way. And unfortunately, in many instances, there's not a hugely easier way, but we would say, by all means, ask your customs broker. Folks like Billy, they're experts in this area. Or for other folks that have a customs consultant or some of the larger accounting firms who have an excellent customs and trade practice or customs counsel. And also you can ask customs for a ruling. Depending upon the nature of the ruling, in many instances, you can get a ruling from customs within 30 days. In addition, though, we also want to emphasize that these tariffs affect customs bonds and bond sufficiency information or bond sufficiency letters or insufficiency letters. And Billy, I think you have a few comments on those issues as well.
Absolutely. This is the landmine that companies find themselves stepping on when, you know, planning on raising prices, mitigating tariffs, and doing all the right things you should do. Don't overlook your customs bond. So every importer into every entry into the U.S. is secured by a customs bond, generally what's called a continuous bond, which is a three-way contract between the importer, a surety, and customs, which allows for the immediate release of goods and protects the revenue should customs come back later on and find issues having to do with admissibility, etc. So I want to talk about how customs manages its bond sufficiency. The back of the napkin math is that a bond must be 10% of the duties, taxes, and fees from a previous 12-month period. What's overlooked here is that it should cover 10% of the anticipated duties, taxes, and fees in the coming 12 months. So the way customs operates is they run a report based on bond sufficiency during the tailing 12 months each month. And when a company is found to have an insufficient bond, they issue an insufficiency notice, which gives approximately 30 days to get a new bond. I want to go over some metrics to the next slide, which I think really talk to this issue. So this is the number of bond sufficiency letters issued. And I think it's laughable that in 2004 there was 93. I think we had at least 93 and you know, almost per month it felt like, going back to 2018. So with a little bit of history here, do we remember what happened in 2018, 2019, and 2020? These were the effects. These were the effects of the Trump tariffs under the first administration under Section 301, Section 201, and Section 232. What happens when a insufficiency letter is issued is an importer has 30 days to get a new bond. Generally, a surety wants to know their exposure and their risk. So prior to writing a bond, they want to review an importer's or principal's financial statements to understand exposure, and often will require collateral in the form of cash or letter of credit. This is a lot of things that need to happen in a 30-day span. And if it does not happen in a 30-day span, importers are in a position where they either need to get single entry bonds or they can't import at all if they can't get single entry bonds approved because they require the same approval. So protecting your bond and protecting your is protecting your importability. This next slide covers a very common issue in cases like this of tariff increase. You know, this walking through an example of bond stacking. So let's say a bond is filed in July 2022 for $500,000. The bond is renewed in 2023 based on new import activity for $1 million. In November 2023, the bond renews in 2023, so the exposure is $1 million because there's two $500,000 bonds on file. In 2023, an insufficiency notice is issued to the importer to increase the bond to $800,000. Too many importers take this insufficiency notice at face value, based on customs saying this is the bond amount they need. They assume that's right. They increase their bond 800,000 without considering what the future is going to hold. Now the surety's exposure is 1.8 million. The surety is being exposed to more liability than they need to, is the message here. March 2024, just 13 months later, another insufficiency notice is issued for requiring $1 million bond. Now the total exposure is 2.8 million. If we started with $1 million bond, we would avoid this stacking liability, which frees up cash and reduces liability for the surety and makes everyone happy. Happier.
So we'd like to finish the slide portion of the presentation with some suggestions to folks to try and minimize the impact of these tariffs as much as possible. And the first thing we're emphasizing is you're not going to necessarily get to zero, but get as close as possible to the price from the actual manufacturer. Avoid middleman markups. If you have the manufacturer selling to a middleman, reselling to the US, there are provisions that you can use under what is called first sale to get back to the first sale, the sale from the actual manufacturer. Even if you don't have that, you need to be careful about certain situations. If the goods are being sold to the importer of record, who may or may not, who may be reselling the goods to customers in the U.S. But the point is, the closer you get to the price from the actual manufacturer, the lower the basis of the goods on which the duties are going to be applied. The second point is that there are a number of costs that can be properly and legally stripped out of dutiable value. We're not listing every one of those costs here, but some of them, for example, foreign inland freight, any charges incident to the international shipment of the merchandise, interest, testing, foreign government charges, port fees, anything like that. If you have questions on that, once again, consult your customs broker, your customs expert, a customs attorney, and they can give you more specific advice on what the actual requirements are for any potentially non-dutiable charge. In certain instances, for example, foreign inland freight, they want a through bill of lading. In many instances, you're going to have to provide the actual amount of the cost to withstand audit, or if you get a request for information. But nevertheless, particularly with the duties going up to the in aggregate the percentages that we showed you before, whereas a year or several years ago, these additional charges might not have been worthwhile. Now, all of a sudden, they become significant in saving money and reducing dutiable value. We would also point out that to the extent that some of these tariffs are country of origin specific, that you should look at the rules for country of origin, whether it's substantial transformation or whether it's the rules in 19 CFR 102. If you can change the country of origin legally, that might be a huge savings. For example, if you are assembling goods in China with components that originate elsewhere under certain circumstances, that might be possible. We would caution people, however, that if you are going to start purchasing goods from other countries, all of a sudden, you want to be very careful that that the new factory or new vendor you're using is not simply engaging in transshipped goods. That would just get folks into a world of hurt and penalties and things that you don't really want to be facing. We would also point out that you really need to look at all available options in the tariff itself. So for example, in Chapter 98, 9817, 0050, which is an agricultural exclusion, that gets you out of 301 tariffs. But Billy, correct me if I'm wrong, I don't think that 9817, the agricultural provision, gets you out of 232 tariffs or IEEPA tariffs.
I do not believe it. It definitely does not IEEPA, and the Section 232 apply as well. But hey, 25%, that's some good savings for low amount of work relatively.
And so, as a broker, Billy, what additional tips or ideas would you suggest for folks looking to save on the tariffs?
Yeah, so Bob covered, the ways you can mitigate, the ways you can avoid. This talks about delaying. So when I look at delaying the duty payment or avoiding in some ways, I first start with foreign trade zone and bonded warehouses. I know what you're thinking. You just said that there's issues with foreign trade zones on IEEPA, and that is the case. There's restrictions, but you still have the benefit of duty is not paid on products until it comes out of the foreign trade zone. So you're paying duty after something is sold potentially, or if something is exported to another country from a foreign trade zone, you avoid the duty altogether. So that is still significant, and I think that that's worth the price of admission for quite a few clients. The easiest thing you can do, if you haven't already, is sign up for periodic monthly statement. So generally, in the regulations, if you look up when is duty due, it is 8 days after an entry is made. The periodic monthly statement program consolidates this, so you are paying duty once per month for entries entered in the previous month. So if all entries that were processed in February will be due and payable on the 15th working day of March. I can't give you a exact date of what this means for your cash flow and your payment terms. It averages around 36 days in case studies that I've been involved in and looked at, which is much better than 8 working days or whatever your customs broker would require. In addition, many customs brokers will assess duty outlay fees anywhere from 2% to 10%, which is a significant drain. By paying customs direct, you're avoiding these. So this is a key program to use if you're not already. And then the information on customs website, sometimes it can be slow, but it's been thorough. Customs has done a really good job of answering questions when they've got answers. We have 3 FAQs here and hope to get more and more in the next coming weeks and months.
Great. So with that, we've saved some time for questions, and we'd like to kick it back to Brian. Brian, are there questions that came in that you'd like to raise that we can field?
Yes, certainly. A lot of information. Thank you so much for going through quite a lot of detail in such a short amount of time. Based on the number of questions that have come through, we will not get a chance to ask all of them. We're going to try to jump through as many as we can. The first one, though, Bob, you advise folks about getting a ruling. How does one go about doing that?
That's a great question. There are 2 ways that you can get a customs ruling. First of all, there is a online portal where you can submit your ruling request online. The rulings submitted that way, they're typically handled by the national import specialist or the national import or the assistant national import specialist. Assuming your ruling request is complete, you typically will get back a ruling within 30 days. The rulings through the national import specialist through the portal, they tend to be much shorter than if you submit a ruling request directly to the Office of Regulations and Rulings at Customs headquarters. The difference, though, is at the Office of Regulations Rulings, OR&R, at headquarters, you tend to get a more in-depth review. It tends to be more legally oriented. It's an attorney who's probably looking at various provisions. So depending upon the issue, depending upon your timing, and depending upon the documentation you have, you can go either through the portal or directly to headquarters. Headquarters is probably taking you at least 6 months, maybe a year to issue a ruling, as opposed to the NIS, which is supposed to be within 30 days.
Thank you, Bob. And William, just real quick, for brands and retailers that leverage the de minimis today for goods originating out of China or even now Mexico or Canada, what are the considerations for them when the de minimis will go away?
Yeah, it's a great question. So obviously the elephant in the room is the cost, right? Items that were entered duty-free now have to have a mechanism where duty is assessed, collected, and we expect the brands to look to pay most of these duties directly and then increase their costs. We could see a slight difference as we look at how USPS will operate. But what I think is being under considered is the additional data of what's required for a informal or formal entry of product as opposed to a de minimis or type 86 entry. So right now, a type 86 entry has 9 data elements. Some of the most significant ones coming from the brand or retailer are tariff classification, product description, and a fair market value in the country of export. Switching that to a formal entry, based on the tariff number, every tariff number could have a different reporting element. Basically, all of apparel requires net weight. Most of apparel is in dozens. Most of footwear is in dozen pairs. So is the current systems in place to give this data to a broker? Does that incorporate the required reporting elements based on the harmonized tariff number? The other piece is apparel. Any import of apparel requires the manufacturer information of the actual manufacturer. So is this tracked? I expect that a lot of brands that might be fulfilling orders from the EU or from Australia, they might just have a bin where they're pulling product from, and they might not know where that T-shirt was made in the factory had information from China or anywhere else. The other piece is the customs bond. These companies are likely to be required to obtain a customs bond. I know there's some questions around this, but customs has been very clear in the past that though the regs say an entry type 11, an informal entry, does not require a customs bond, customs has said in the past that if that duty is being paid on a statement after entry is made, that release needs to be secured by a bond. I am not aware of a way of paying a time of entry outside of sending a check to the port, and there's roughly 4 million packages a day entering de minimis, so I don't think we're going to see 4 million checks a day going to the ports. So that infrastructure is important, and who is going to post that bond is a key consideration.
Quite a lot to think about. But we're going to start to go through a lot of these questions still while we have time. Next question is, we are a U.S. distributor of tower cranes and sold a 2018 used crane to Canada. The original country of origin is Spain. Since the origin is from Spain, will these tariffs affect our sale going into Canada?
So assuming this will transship the U.S., I mean, as soon as this will avoid the U.S., it'll avoid U.S. tariffs. I'm not sure the tariff environment on cranes to Canada. I know cranes can be somewhat sensitive in the U.S., so my recommendation is that our material will not apply if you do not enter this into the U.S., and I would avoid doing that.
And I think also that brings up a great point, which is we've been talking about the U.S. tariffs applied on goods, but obviously there's reciprocity, reciprocal tariffs by countries imposing goods coming from the U.S. Canada and the EU have each indicated that they will be imposing tariffs of over $20 billion. So to go to the example that you just gave, Brian, I would think that that company would want to be very careful to substantiate that the origin of that product going into Canada remains Spain and is not somehow transferred, does not somehow become U.S. by virtue of being shipped through the United States.
Thank you both. Next question. Since the tariffs are currently changing so frequently, is there a specific website or location that you can recommend watching to keep current?
Yes. The website would be well, there would be several. So first of all, there's the customs website, www.cbp.gov. And then also individual organizations have been putting out information. I know that on Husch Blackwell, we have an international trade blog, which has been updated every day for what's going on. And I know that a number of the brokers also and logistics companies have also been putting out key information to keep folks updated.
I say this tongue in cheek, truth social, but there is some truth where the speed at which this is moving, and I think that at this point we can say any threat should be taken seriously with how many tariffs have been implemented and what has moved very quickly. The dialogue on a day-to-day basis is important. So we at CECO, we're trying very hard to only put out notices that are relevant and in effect, that might be too late for your business. And there's a need to go through transcripts of interviews daily. That's what we're doing. But it's difficult to try and parse out what's reality and what is negotiating tactic. But definitely all the official websites, and there should be a chain of command in terms of a presidential order cascading through a CSMS, which is a customs message implementing the tariffs.
And I think that also raises a good point, which is if a company imports goods and for some reason they weren't aware of the most recent tariff rate or requirement or something, there are opportunities to correct an entry after it's been made. Folks can go to the broker and have the broker make a post-summary correction. For example, you can also, if it's value, you can bring in the goods under what's called reconciliation, which gives you an additional number of months, I believe up to 21 months, to file the correct information. So folks should not panic if they don't actually have every little bit of information. There are things that can be done by consulting with the broker or going to the broker to correct matters, or to a customs expert or customs attorney.
Thank you both. Next question. What is the likelihood that there will be tariff relief for goods imported in support of government contracts and or to meet defense requirements?
I would like to address that. And the answer is that depending on who you talk to, the mindset of the administration is that they don't want to grant exemptions. But obviously, merely by the fact that they're kicking out the effective date of these by 30 days and sometimes more means that there are opportunities to get in front of the right person and to get clarification or to get a modification of certain tariffs. Whether they would modify it for a particular government contract, for a particular company, for a particular country, I think that all of that is very transactional. Our experience has been, however, that they do not want to grant exemptions or exclusions or whatnot to the extent that it can be avoided, to the extent that they don't have to.
I would certainly agree. I mean, the priorities of government procurement often will reflect the priorities of the administration from a trade policy perspective. Advocacy is always worth a shot.
Good points. Next question. This is a bit of a long one. Are tariffs from the U.S. and counter tariffs from Canada and Mexico based on country of origin? So, for example, if a U.S. company is a subsidiary of a German company and imports goods from Germany, where the country of origin is Germany, for a shipment to Canada or Mexico, will these be eligible for Canadian or Mexican counter tariffs? Please clarify.
So everything that we've talked about is how the U.S. would assess tariffs on goods coming into the United States. And if, to take a situation, if you had goods from China that were shipped to Germany and those goods were then brought into the United States, the question would be, what's the country of origin of the goods? Did they undergo a substantial transformation in Germany or in the intermediate point of shipment? With respect to how Canada and Mexico would handle that, they obviously have their own rules. We would have to go and speak to our counterparts in Canada or Mexico, and I think the answer would be that it's really going to depend on the particular product and whatever processing or manufacturing might be done to that product prior to entry into Canada or Mexico.
All right, we've got time for one last question, and that is, if I am importing a fabricated part made out of aluminum, and am I tariffed for both the part cost and the aluminum content?
I'll take that one, Bob, and you can correct me if I go a different direction. But there are a lot of questions about this, so I'm glad we got to this one, Brian. You have to start with the tariff classification number. So assuming this is on derivative products, you really fall into two categories. Is this aluminum derivative product that is falling within classification in Chapter 76 or without? If you are within Chapter 76, the 25% applies to the entire item. If it's without, your first question, if you have a tariff number that is on the list of derivatives that is not in 76, your first question should be, do I have aluminum in the product? A lot of them might not have aluminum at all, which you would not have to pay aluminum tariffs once ACE is updated. If the product does have aluminum, you can just pay duty on aluminum content, assuming the entry is made correctly and you have an articulable way of how you got to that value.
I think that is spot on. The only thing that we would add is, as Billy mentioned, how are you going to calculate the value of the aluminum? There's a number of different ways it could be done, okay? But to go back to what we talked about during the presentation, whatever you do, make sure that you can support it with documentation and make sure that whatever you're doing, it's reasonable.
All right, thank you both. And for everyone else that had questions, we will get back to you. We will follow up with you directly. Thank you again for joining us today. We hope the information was helpful to you and your organization. As a reminder, this program has been approved for legal education hours. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. This concludes our webinar. Thank you all so much. And thank you to our presenters, William and Bob.
Thank you.
Thank you, guys.